not be putting up with what's happening in North Korea. We'll see what happens. We'll see what happens. Certainly that's not a first choice, but we will see what happens.
The president there in the White House once again leaving all options on the table as it relates to North Korea. The U.S. has a proposal for new UN sanctions that would put an embargo on the Hermit Kingdom's oil and textile trade. Joining us right now, Janney, Montgomery, Scott, Chief Investment Strategist Mark Luschini. Mark, good to see you. Thanks so much for joining us. Typically, markets don't respond to geopolitical events, right? I mean, well, North Korea and markets, how do you see it?
Well, I think markets do a pretty good job of digesting pretty quickly the economic impact, and assuming there's little or no, then they move on to the next thing. After the end of the day, it's economics that matter more than politics or geopolitics. That said, it does tend to put the market back on its heels, particularly when valuations in the U.S. are stretched. And we don't know what this is going to escalate to. Typically, the arc of diplomacy is you have significant duress that ultimately leads to a diplomatic outcome. The question is, what happens between now and that? And as well, if there was by chance an accident, God forbid, then that could enlist obviously allies or non-allies into a conflict that could have economic ramifications. So I think the market is very much in a kind of show-me state as it relates to North Korea.
Yeah, but Mark, this isn't signaling a serious crackdown. I mean, China supplies all of North Korea's energy and oil and a lot of its food here. You know, calling on the UN for more sanctions, you know, isn't really doing anything. Is that why we're not seeing the market reaction right now?
I think it's largely more symbolic than it's having obviously an economic impact. Arguably, it's having more of an impact on the citizens of North Korea than necessarily the government. And arguably, you're backing if you will, an animal into a corner that could actually do something that would, you know, perhaps end-run game theory as it relates to what the likely outcome is going to be. So I think the market is looking at this as something that obviously we've seen these kind of dissipations of this kind of bombastic rhetoric over the time, and hopefully this is going to be another reset of that before we see any kind of military conflict. Obviously, as it relates to China and the importance of the global trade, the emerging market complex, commodity-related activity, all of that's hinging on China's role in the global economy. And so obviously any kind of impasse as it relates to some kind of a trade war as a consequence of these sanctions, that could deteriorate economic conditions on a global basis, not unlike we saw in the beginning of 2016.
And Mark, as you know, what are you telling your investors as the chief investment officer? We saw the other day a pullback in the equities and people fleeing to gold and treasuries. I mean, is that what's causing some of the adjustment out there because of these political actions?
I think so, Bob. What we've seen historically is that the instrument that works best as a defender of capital in the midst of a geopolitical crisis, not a financial one, is gold. And so it's a natural reaction. In fact, we've advocated a hedge in gold as a consequence of that during this period. Ultimately, I don't think it has a store of value, but in times like this, it works perfectly well. That said, the thing to brace for, in our view, is something more protracted and severe, and that would be a recession in which I think it would be warranted that you see a massive derating in equity prices as a consequence of the obviously markdown in corporate earnings that would come as a consequence. That is, in our view, an exceedingly remote possibility at this juncture. Yep. So to the extent that this actually leads to a correction, some kind of a pullback in equity prices, we would be buyers as opposed to sellers, or fear that this would necessarily derail the economic or financial bull market.
Wow, recession. I wasn't thinking about recession. I thought we were looking for 3% growth.
Remote. 2019, 2020, maybe.
Okay. In terms of allocating capital, do you want to be in U.S. stocks? You want to be in Europe? I mean, we've got the ECB meeting later this morning. What do you expect there? And I know you've been bullish on European equities.
We have been. We continue to be, as a matter of fact. Still, the earnings growth profile there is pretty steep. Valuations remain at a discount to the U.S.-based counterparts. And obviously, last year, Europe posted growth that exceeded that of the U.S. for the first time since the late 1990s. So
that's incredible, actually.
It is. They're growing above trend, and their central bank is lagging the actions of the U.S. Federal Reserve. So we still look at them as being highly accommodative, even though we do expect Mario Draghi to begin the end of emergency measures that, you know, withstood the test of time, and to some degree he's taken credit for in helping to restore this above-trend growth in Europe, but will likely begin to at least, I think, talk about the unwinding of quantitative easing, not coming anywhere near tightening by way of raising interest rates.
Mark, everybody talks about the North Korea situation, how it could affect the worldwide markets. I'm going to throw something out there that I've not heard. Everybody says, okay, China's the key to making this all work out. Nobody wants to get engaged in a military action. Let me put something on the table, totally radical. Give China the opportunity to annex North Korea. Just annex them. Take them. You know, they're the only ones who can manage it. They're the only ones who can do it. And I know that's a bold...
Well, you know what? Then you're going to get U.S. troops out of the Korean Peninsula, because that's ultimately what China wants.
Absolutely.
I mean, my question to you, Mark, was the Trump administration still isn't looking serious about tackling this, because if they were, then they would put a trade embargo in place against China, and that's the thing that markets would really react to. But that's not what they're proposing right now.
Doesn't that impact the entire economy? Doesn't that hurt the U.S. economy,
what's
putting a whole embargo on China?
But what's worse? You want an all-out war in the Korean Peninsula, or do you want to actually put pressure on China to do something about Pyongyang?
Wow.
I think you're right. I think China has a vested interest in not engaging the U.S. by way of bringing troops even closer to the pivot that's already underway to move over to the Asia-Pacific area, particularly the South China Sea. So to your point, that's perhaps one way to solve for it, to kind of de-teeth, if you will, North Korea. But at the same time, it brings probably U.S. troops closer by way of South Korea than what currently persists, and that would be problematic for China, particularly at a time when, you know, President Xi is working in strong effort in order to maintain the status quo going into the National Party Congress here in October. So if anything, he wants tensions to subside, not escalate.
Real quick before you go, tax reform. How much is that priced into the market at this point? And if we don't see it by year end, but big sell-off, what do you think?
Maria, I don't think so. If you look at the high tax bracket stock basket, if you look at the small cap versus large cap, if you look at the performance of some other areas, the infrastructure stocks that all rallied hard on the post-election, campaign fodder that was going to turn into legislation and hasn't as of yet, they've completely unwound the gains that were made early on. This suggests to me there's literally no optimism whatsoever we're going to see any kind of corporate tax reform.
Wow.
Therefore, I think if we do, and I think there's a good chance we do, I think Congress needs a legislative victory desperately going into the midterm election, then I think that is a boost for equity prices if it happens before year end or even in 2018. I don't think it's necessary to sustain the economic expansion. I think it would be a game changer by way of corporate profitability and therefore market conditions. Very bullish.
We'll be watching. Mark, great to see you.
Thank you very much.
Always a pleasure to have your insights. Thank you. Mark Luschini there, Janney, Montgomery. Coming up.